Michael Burry became famous because he predicted the U.S. housing market collapse of 2008. He gained $100 million for himself and $700 million for his investors on the backs of hazardous bets he made that paid off. What makes Michael Burry a legendary investor? And why is he saying there will be something worse than a recession next year? Michael Burry is a well-known investor, and he is worried that the dangerous combination of high debt and rising prices will send the stock market down even more. The American economy will most likely have a soft landing next year, or so many experts hope. Goldman Sachs Research forecasts that the largest economy will barely avoid a recession as inflation falls and unemployment increases. But Michael Burry sees a very different scenario. The investor who became a household name because of The Big Short has expressed concern about the state of the market. Michael Burry claims that the current degree of stock market speculation has yet to be witnessed since just before the 1929 crisis, and that asset values are more inflated now than before the dot-com bubble's collapse. He's also worried about how the economy and politics are doing compared to the 1970s. He is worried that the authorities in the government, such as the SEC and the Federal Reserve, are not doing enough to avert an economic disaster. More conjecture than in the Roaring Twenties, Mr. Burry tweeted. There is more overvaluation than in the 1990s, he noted. Compared to the 1970s, economic and political obstacles were substantially larger. One of his other tweets read, "Players clutch the barrel of Kyle Rittenhouse's gun as at SEC/GOV and at Federal Reserve not in agreement. The electric car firm is worth $120.5 billion, according to an editorial he attached from the Wall Street Journal, yet they only sold 156 vehicles. Ford and Amazon have invested heavily in Rivian, an electric car company that went public this week and is quickly surpassing Tesla's market value in the United States. The firm has a market value of almost $100 million after its first day of trading, despite selling less than 200 automobiles and having almost no income to show for it. By the decade's end, the corporation hopes to have increased yearly manufacturing to more than 1 million automobiles." In a tweet this week, Mr. Burry speculated that Tesla CEO Elon Musk might be selling company shares to settle personal debts. Additionally, he foresaw that the firm's value, like many others during the dot-com disaster, could fall by as much as 90%. He referred to May 2020, when even Mr. Musk said the company's valuation was too high when it was worth about 16% less than it is now. Since then, the tweet has been removed. Mr. Burry's precise forecast of the housing market bubble of the 2000s is one of his most significant achievements. In other words, he shorted the housing market or sold positions in the market, hoping to profit from a drop in home prices. To his expectations, he made a fortune during the market crash in 2007 and 2008. The housing market collapse cost 3.8 million Americans their homes and set off a worldwide financial crisis that helped bring on the Great Depression. Average yearly mortgage rates in the United States are currently above 6%. This is additional bad news for homebuyers already dealing with record prices. Rates for 30-year fixed mortgages hit an all-time high of 6.28% before dropping to their current level of 6.03%. The last time this rate was this high was in late 2008, at the depths of the Great Recession and the financial crisis. This indicates that during the previous year, mortgage interest rates increased by a factor of 2. They were averaging around 3.12% by the middle of June in the year 2021. The economic effects of the last health crisis and the supply chain problems it caused, along with Russia's war in Ukraine, which hurt commodity exports and drove up global energy prices, have contributed to inflation reaching 8.6%, making the increases a foreigner to a likely increase in short-term interest rates by the Federal Reserve in the United States. The Federal Reserve increased its benchmark interest rate by 0.75 percentage points. Bank forecasts indicated that economic growth would weaken and unemployment would climb over the next several months, with the latter hitting 3.7% by year's end. To put another way, this was the biggest boost since 1994. Members of the Federal Open Market Committee said that inflation remains high due to supply and demand imbalances associated with the last health crisis, increasing energy prices, and other pricing pressures. The committee is very dedicated to getting inflation back to its desired rate. Using the same example home price of $447,000, many experts determined that a rate hike would boost annual mortgage payments by more than $8,100 or more than $700 per month. The effect over the course of a 30-year loan would be an extra $244,000 in payments. According to Nadia Evangelou, senior economist and director of forecasting at the National Association of Realtors, a 15% increase in housing costs would prevent 18 million American households from obtaining a new home next year. She noted that many people who may be interested in making a purchase now can't afford to. The Mortgage Bankers Association's data confirms the trend of declining interest in obtaining a mortgage, which has plummeted by over 15% from the same period last year. Those who want to buy will have to settle for less costly homes or keep renting for the time being, crossing their fingers for a better market. If they keep renting, their savings might be depleted as their income stagnates and their rent steadily rises. If rising mortgage rates inhibited buyers, lower prices would be expected to boost transactions. Nonetheless, at now, that does not seem to be the case. Instead, buyers are making sizable down payments in an attempt to beat the market before it gets much worse. The number of available properties is decreasing, as the National Association of Realtors reported. For every house on the market, there are usually 5 people interested in purchasing it. The eventual level of mortgage rates is dependent on how much the Fed needs to alter its own rates to battle inflation. While each rate is unique, their futures are bound together and tend to move in tandem. Len Kiefer, Freddie Mac's deputy chief economist, claims that mortgage levels have been 3 times higher in the past, peaking at over 18% in 1981. From a historical viewpoint, it's not at all a high rate, he said. How can we best prepare for a return to economic growth after this devastating recession? Burry aired his latest warning as the Federal Reserve hiked interest rates to curb inflation without causing a recession or hurting the job market. The chairman of the Federal Reserve, Jerome Powell, has cast doubt on the likelihood of a soft landing for the economy. According to Rubini, some of us have been anticipating for a long time and creating a complete case for the great stagflationary debt crisis. Since last year, Burry, an outspoken economic pessimist, has consistently warned that the U.S. stock market is in the middle of a massive decline. For the second time in a month, Burry has declared that he is taking a position adverse to some sectors of the U.S. economy. Burry didn't name the assets he was shorting in his piece, but it came out around when the sudden demise of FTX made investors paralyze the whole cryptocurrency market. Burry remarked, "You don't know how short I am." Burry also tweeted that he believes people will flee digital currencies in favor of gold as a store of value. As interest rates were steadily increasing by the Federal Reserve in September, Burry expressed concern that the market may worsen to the point where it resembled the Great Depression. This week, Mr. Burry has also spoken about inflation. He said that the current inflation pace was making any income increase meaningless. In addition, he claims that the poor would be hit especially hard by this tax, labeling it a regressive tax. He noted that the inflation-adjusted decline in real wages in the United States had been 2.2% since January 1st. This is the only noteworthy thing that has happened all year. Inflation is effectively a tax, and those who can least afford it are the ones who feel its effects the most. This is something you should constantly remember. Mr. Burry is known for his pessimism and ability to predict the worst-case scenario. There will be a major recession in 2023, something worse, or is this another false alarm? Tell us in the comments, leave a like, and subscribe for more videos like this.